Our Market Monitor guest tonight says there are some large cap stocks that are cheap in this market. He's Gregg Abella, portfolio manager at Investment Partners Asset Management. He joins us on set tonight. Gregg, good to have you with us. Nice to see you again.
Thank you.
You like the big caps. Give me your thought overall on the market quickly in a capsule.
Complacent.
Complacent.
If I had to come up with one word. I think that the earnings multiples generally in some of the indices are just extended. We're due for a healthy pullback. It's just a normal phase of the market. So even though I think there are some large cap names that are compelling values here, I'd be even waiting another 5 or 10% to put my money to work.
And as you look at the market more broadly, I assume that one of the reasons you like some of the big caps that we're going to get to is that some of the other smaller caps you think are overstretched by a long shot.
That's right.
So let's start with your first pick, and there is no bigger or blue chip probably than ExxonMobil.
Well, Exxon is a compelling value here. It did get downgraded today, but was only down in line with the market. In fact, it was the price target that was actually lifted a little bit from that analyst who downgraded it. But you know, a $500 billion sales-based company with a 2.7% dividend yield, trading at 12 times forward earnings. It looks like decent value. And then, as I mentioned, with a pullback, I would be putting money to work in a name like Exxon. It's treated shareholders very well over a long period of time. Good
company, presumably, just to have as an anchor in your portfolio.
That's right.
Let's move on to another one, which is a controversial pick, I would say, and that's IBM.
Well, IBM, I think, is suffering a little bit from the lackluster capital spending in information technology and corporations. But the company is in a very interesting space. Platform as a service and infrastructure as a service on a $100 billion sales-based company trading at 10 times earnings. Again, a 2.5% dividend yield.
You like this deal with Apple? You like Ginni Rometty?
Yeah, I actually I think they're on the right track. I'm in good company. There's about 6.5% of the company is owned by Warren Buffett's Berkshire Hathaway. So as a value guy, I can identify with why other people would think it's compelling. Again, on a pullback, I'd probably be putting some money to work in this name.
And the third choice is Prospect Capital Corporation. I'm not familiar with it. Tell me about it and why you like it.
Well, this is a specialty finance company. It's a business development company. It lends to small and mid-sized companies where the banks really can't participate right now because of Dodd-Frank. They lend at pretty high rates. They pay out 90% of the income that they make to the shareholders, as business development companies do. And as a result, it has a yield currently of about 12%. Now, there's some risk with this because
12% yield. Whoa, wait a minute. That often is a danger sign.
It can be, but that's not uncommon with business development companies to pay out those kinds of rates. The risk being
the nature of the structure, not
nature of the structure,
more than the risk.
And it's diversified over dozens of companies, but they are smaller companies, and business development companies have to raise capital to continue to grow.
So, by way of disclosure, do you own any of these companies personally? Does your company own them? What?
Our clients own them.
Your clients own them in portfolios that you run for them.
Correct. And on pullbacks, I would be looking to probably add to these names.
All right, Gregg. Thank you very much.
No,
have a great weekend.
You too.
See you again soon, I hope. That's Gregg Abella with Investment Partners Asset Management.